Every finance video you've ever watched started in the middle of the story, not at the beginning. The middle. They assumed you already had the foundation, the baseline context that makes all the other stuff click into place, and they just started talking. Compound interest, diversification, net worth. And you sat there, understanding the words individually, not quite understanding what was actually happening. That's not confusion. That's a missing introduction. This video is that introduction, the one that should have existed before any of the others. Here's what every finance video skips before it starts explaining things. They assume you already know what a bank actually does with your money. Not just that it holds it, but what it physically does with it the moment you deposit it. They assume you know the difference between saving and investing as two separate tools with two different jobs, not steps on a ladder. They assume you know why inflation matters to you personally, not just as a news word that means prices went up. They assume you have a working understanding of interest, and critically, that it runs in two directions, not one. Nobody told you those things explicitly. Nobody told me either. They handed me terms. The terms pointed to other terms. And I kept watching videos, nodding at the sentences, and leaving more confused than I arrived, because the foundation was missing. If that's happened to you, that's what this is about. The cost of missing that foundation is real, and it compounds, which is a word I'll explain properly in a minute, but for now, it adds up faster than you'd expect. Every year you spend unclear on the basics is a year your money is not working. Maybe it's sitting in an account earning almost nothing while inflation slowly eats through it. Maybe you're paying interest on something you signed up for without fully understanding what the rate actually meant. Maybe you've been meaning to start investing for 2 years, not because you're lazy, but because nobody told you step one. Not the motivational step one. The literal, practical, what do I actually do first step one. And the thing that frustrated me most, once I started figuring this out, is that nobody in the finance world positions this as a failure of explanation. They position it as a failure of the person. You should have known this. You should have asked. You should have figured it out. But figure it out from where? From what starting point? The starting point was never given. And the longer that goes unaddressed, the more expensive the confusion gets. Not dramatically. Not all at once. Just quietly, steadily, in ways that are easy to ignore until you sit down and actually do the math. So let me give you the actual introduction, the context that should have existed before anything else was explained. First, money is a score. That's the most honest way I can put it. Money isn't a thing the way a table is a thing. It's a number that a society agreed carries value, that you can hand it over and receive goods or services in exchange, because everyone accepts that agreement. The bill in your wallet isn't intrinsically worth anything. It's worth what everyone collectively believes it's worth. A government can print more. The value can change. The agreement is what makes it real, not the paper or the number in an account. I'm going to go deeper on this in the next video, because the actual answer to what money is gets genuinely strange. But for now, the working definition is, it's a collective agreement about value. A score that moves between people and institutions. Second, your bank is not a locker. This was the one that shifted something in my head. When you deposit money into a bank, the bank does not set it aside in a compartment with your name on it. It lends most of it out, immediately. This system is called fractional reserve banking, and under it, banks are required to keep only a fraction of total deposits on hand, lending the rest out to borrowers. The fraction varies by country and by period, but the core mechanic is consistent. Your deposit goes into a pool, and most of that pool is out in the world, funding someone else's car loan or mortgage or business credit line. The bank still owes you your money whenever you ask for it. That part is guaranteed by deposit insurance in most countries, up to a certain amount. But the money isn't sitting there. It's working, just not for you. Knowing this doesn't make banks bad. It just makes the mental model accurate. And an accurate mental model is what makes the next concepts actually land. Third, interest has two directions. Most people learn one direction first, and it's the expensive one. When you borrow money, you pay interest. The lender charges you a percentage of the amount for the time you're using their money. Credit card, car loan, mortgage, student loan. That direction gets explained clearly, usually with urgency, sometimes with a slightly alarmed tone. The other direction, when someone else uses your money, they pay you interest. A savings account does this. In theory, your bank is using your deposits, so they owe you a small percentage back. Investments do this too. At a more complex level, you're putting your money into something, and that something returns more than it took, ideally, over time. Same concept. Two directions. One was explained to you in a way that cost you money. The other, the direction that can work in your favor, was presented as a minor footnote on the back of a pamphlet. That asymmetry in how interest gets explained is worth noticing. Fourth, inflation is not a news word. It's a tax nobody voted on. Inflation is the process by which the purchasing power of money decreases over time. Most central banks globally target around 2% annual inflation as what they consider stable and normal. What that means in practice: $100 today buys slightly less than $100 bought a year ago. Over 10 years at 2% inflation, $100 loses roughly 18% of its purchasing power. Over 20 years, close to a third. Same math applies whatever currency you're working with. This is why just save your money is not a complete strategy. Saving is necessary, but money sitting still, not growing, is not neutral. It's losing. Quietly. Every year. There's no notification. No alert. It just happens in the background. The practical implication: if your savings are growing slower than inflation, your money is shrinking in real terms, even while the number goes up. This is the thing that makes the difference between where you put your money actually matter. Fifth, saving and investing are two different tools, not two stages. Saving is keeping money liquid, safe, and accessible. It doesn't usually grow faster than inflation, but it doesn't lose value suddenly either. You save for things you'll need in the near term, for emergencies, for stability. Investing is putting money into something you expect to grow over time: a company, a fund, property, with the understanding that growth comes with risk. The value can go down. It can also go up more than savings ever would. Neither is the smart version of the other. They're different instruments for different purposes. The mistake most finance content makes is implying one naturally leads to the other, like levels in a game. Save first, invest when ready. The problem with that framing is when ready never gets defined, so people stay in saving mode forever, slow losing to inflation, waiting for a signal that never comes. Sixth, and I think this is the one that needed to be said first, financial literacy isn't one thing you learn. It's a stack. Each concept assumes the one below it. Interest assumes you understand what borrowing is. Investing assumes you understand what interest does over time. Portfolio diversification assumes you understand what risk means in this context. Retirement accounts assume you understand tax implications. If the bottom of that stack was never explained, everything built on top feels unstable. Not because you're slow, because the foundation is missing. Here's the part that nobody says out loud, though, and this is where I think it actually gets uncomfortable. The missing foundation? It wasn't left out by accident. Financial literacy has been framed as personal responsibility for decades. If you don't understand money, that's on you to fix. Read a book. Watch a video. Take a course. The system works. You just need to learn how it works. But here's the thing that took me a while to sit with. The gap in financial education didn't happen by accident, and it wasn't an oversight. Teaching financial literacy was not included in most public school curricula. Not because the concept was unknown, but because there was no sustained pressure from the right directions to include it. The people designing those curricula weren't the people who needed the knowledge. The people who needed the knowledge weren't in the room. And the financial industry, banks, lenders, credit card companies, has historically operated fine, arguably better, when customers don't fully understand the products they're using. A person who doesn't understand how interest compounds on a revolving credit card balance is a more consistently profitable customer than someone who pays it off every month. Not because anyone is cartoonishly evil about it, just because confusion and inertia are genuinely profitable in financial services. The product is designed to be used. The instructions are not designed to be understood. I had to sit with that for a while, because I'd spent years assuming I was just not getting it. Like there was a manual everyone else had received that I somehow missed. Turns out, the manual doesn't really exist as a coherent thing. It exists in pieces scattered across textbooks, bank websites, Reddit threads, YouTube channels started by people who figured it out mid-career and wanted to share. None of it is sequenced. None of it starts at the beginning. The other piece nobody says clearly: the vocabulary itself is a filter. Terms like amortization, yield, liquidity, equity, portfolio allocation, marginal rate. These are not complicated concepts underneath the word. They're just words, but they function like a membership test. If you know them already, the conversation includes you. If you don't, everything sounds like it's happening slightly above your head, in a register you're not quite cleared for. And because most finance content assumes you know the vocabulary, it never defines it. Which means people nod along, absorb fragments, and eventually either give up entirely or develop a confident-sounding performance of understanding that masks the fact that they're still not sure what liquidity means when someone says it in a sentence. I did that for longer than I'd like to admit, and I think a lot of people are still doing it. Because it's embarrassing to say out loud. It's less embarrassing once you realize the system was never designed to make it easy to say out loud. Here's what I'd actually suggest, not as a financial plan, because this video isn't that. This is step 0. The 5 things worth doing before anything else makes sense. 1. Map what you actually have. Write down every financial account you currently have and what it actually is, not what you want it to be. A checking account is a transaction account. Money comes in, money goes out. It's not designed to grow. A savings account is storage with mild interest. If you have anything else, a retirement account through work, an investment account, a credit account of any kind, look up what it actually does in one sentence. Not what to do with it yet, just what it is. 2. Find out what you're paying in interest. Every debt you carry, credit card, loan, installment plan, buy now pay later balance, has an annual rate attached to it. It's usually labeled APR, which stands for annual percentage rate. Look it up for everything you're currently paying. Write the number down next to each one. Don't react to it yet. Just know it. Most people have been paying interest on things for months or years without knowing the actual rate. The number existing in your awareness is already different from it existing only in fine print you never read. 3. Find out what you're earning in interest. If you have a savings account, look up the annual percentage yield it's currently offering. High-yield savings accounts, a specific type of savings account offered by various banks in many countries, sometimes pay significantly more than standard accounts. I'm not going to name specific ones because those rates move and I'd rather you check current numbers yourself. But the category is worth knowing exists. If you're earning 0.2% on your savings, that's not a fixed reality of savings accounts. It's a feature of the specific account you're in. Look up the inflation rate in your country right now. Search it. It's published regularly by your government or central bank, usually monthly. Then compare it to what your savings account is paying. If the account earns 1% annually and inflation is running at 3%, your money is losing purchasing power in real terms, even while the number technically grows. That gap is the thing worth caring about. Knowing the gap exists is the only way to eventually close it. 5. Stop treating confusion as a personality trait. This is the one I wish someone had said to me earlier. The gaps in what you know about money are not evidence that you're bad with money, or not a finance person, or too late to start. They're evidence that you were handed a system without an introduction and expected to perform competency in it anyway. You're not starting from zero. Zero would mean no exposure, no context, no vocabulary at all. You're starting from a missing introduction. That's a different problem, and a more solvable one. The concepts are not that complicated. The vocabulary is learnable. The system is frustrating and imperfect and in several ways structured to benefit people who already have money, but it is navigable. And once you know what the foundation actually looks like, the rest of it starts to click in a way that it never did when you were watching videos that started in the middle. That's what the rest of this channel is. Going through it piece by piece, starting from where we actually are. Next video. What is money actually? And I'm serious when I say the answer is weirder than I expected. I thought I knew roughly what money was before I looked into it properly. I didn't. Not even close. That one goes up next. Before you go, one question, and I actually want to know, what's the one finance term you've heard 100 times and still don't actually understand when someone uses it in a sentence? Not a guess at the meaning. Actually not sure. Drop it in the comments. I'm probably going to make a video about it.